Okay, good morning. Thanks for attending today's webinar. Today's series of 5 that we're focusing on, the part 2, is how insurance companies provide index credits. My name is Paul Sanfilippo. I am the marketing director here for PINNEY Insurance, and we appreciate you taking time out of your busy day to come out and spend some time to learn about IUL. Today we have Chris Korf again from North American, who will basically take us through today's webinar, and without any delay, we're going to let Chris go ahead and get the process started. All right, Chris, take it away.
Thank you, Paul, and thank you to everyone who's taken time, as Paul said, out of your busy day to join us. As he had mentioned, this is our the second part in our 5-part Demystifying Index Universal Life Insurance. And what we're going to be discussing today is how insurance companies provide index credit. So let's get started with this. Our disclosures there, of course, compliance needs to have their say. So our agenda today, we're going to be discussing how can companies provide interest rates linked to an index without the downside protection. Why do caps or participation rates move? How can companies afford variable interest rate loans? And then we're going to finish it up with why are annuities and life insurance different? I mean, obviously, besides the normal part, we're talking here is, how are the indexing credits different for annuities, versus an index annuity versus an index life insurance product. So how do companies provide index-linked interest? Well, the first thing a company does with the client's premium dollars is invest those dollars in our investment portfolio. Our portfolio is comprised largely of bonds that are held for duration. This bond portfolio provides a positive interest rate that covers fixed interest credits and doesn't cause a negative return to pass to the policy holder. But then how do we provide the potentially large interest rates to match an underlying index when the bonds may not perform that high? Well, we use call options. Call options are purchased on the appropriate indexes to match our combined policy needs. Most of our bond returns are used to purchase these options. This provides the upside. So let's look a little deeper at these call options. Call options pay off when the underlying index increases over a given time period. So if the index goes up 10%, the call option provides funds allowing us to credit 10% for the policyholder. What if the index goes down? Then the call option pays nothing, and we in turn credit nothing to the policyholder. The structure of our option budget is set up to match our payout needs of our policyholders' index segments. The company does not expect to make or lose money. If the index goes down, the company does not make or lose money because the bond returns paid for the index credits, which provide 0, and we in turn credit 0. If the index goes up, let's say 10% like we said before, the bond returns paid for options which provided funds to cover the 10%. Again, neutral for the company from a profit standpoint. So what happens if the index goes up 20% and our cap is, say, 12, just for an example? So you might be asking yourself, does the company make money then? No. In addition to buying options which pay for any upward movement, we also sell options with a starting point equal to our cap. So in this example, with the cap at 12%, we sell options that have a 12% net payout. So it is, again, profit neutral to the company whether the underlying index goes up, down, or it varies significantly. So let's take a look at the flow chart of how this works. We have an index universal life product the client purchases. They pay premium. Most of that money goes into our bond portfolio. Options are purchased. Index performance determines if options pay out, and then the company credits interest if it's applicable to that client's policy. So why caps or participation rates change? So let's take a look at that. Of course, there are elements that are outside the company's control which end up meaning that we are unable to lock in both a cap and a participation rate. One of them has to be flexible to adjust for conditions. So what could cause caps or participation rates to change? Basically, we're looking at how much we have to spend on the options, or our option budget, and how expensive those options are, which is the option price. The option budget is dynamic because our invested assets will be varying, have a varying return over time. If our bonds are returning a lower yield, we'll have less to spend on call options, which means we may not be able to afford as high a caps or par rates. If bonds are returning a higher yield than we'd in contrast have more to spend on the options, we'll be able to afford to raise caps or par rates. So it needs to be fluid. But it's not only our bond yields. Option prices are a factor. Option prices are a factor that's outside of our control as well. If option prices are lower, we'll be able to afford to raise caps or par rates. If option prices get more expensive, we may have to lower cap or participation rates. So our cap and par rates are largely driven by those two factors. We try to keep our rates as stable as possible, but market conditions could cause us to change caps or par rates at any time. Of course, once an index segment has begun, the client is locked into that cap and participation rate until the end of the index segment, at which point the new or renewing segment would get the cap or participation rate at the time of the segment beginning date. So, once it's locked in, it's there for the year at the anniversary date. It may be changed, left the same, moved up or down, just depends on what the market conditions are at that time. So what about variable interest rate loans? The title of the loan is pretty clear. These rates are variable and can change. Companies change or charge rates for variable loans to approximately emulate the return they had received on that investment portfolio. The outside reference is used as a benchmark that we use is the Moody's corporate bond rate. So we review our variable loan rates on a quarterly basis and make changes when the loan rates are significant enough to warrant a change. So currently we're charging 4%. If a company has a fixed participating loan or a capped variable loan, there is a cost associated with providing that valuable benefit. What we do is we have a variable capped at 6. So of course there's a great benefit if the Moody's rate rises to 7 or more and the variable loan rate remains at a cap rate of 6. There are essentially two ways a company can accommodate for the expense of providing this cap. They can price an expectation of movement in cap rates into the product, or they can adjust the option budget and lower cap or participation rates if the Moody's rate exceeds their variable loan rate and starts costing them money. We here at North American are not immune from pressures on caps or participation rates if the variable loan rate rises. But we have priced into the products some rising of the variable loan rate even above the 6% cap. Also be aware that if the Moody's rate rises to the level of, say, 7% or higher, it is quite possible it means the option budget is rising, which may help provide a rising cap or, to counteract the negative pressures. So if interest rates are going up, that means our bond portfolio probably is as well. So even if rates get higher, we still may be able to keep rates as they are. Generally, it is a good thing to know that a variable loan rate is nice to allow rates to fall as low as possible. But of course, the cap is very nice, but it may have impact on future cap or par rates if the bond returns rise to a significant level. So really what, just to kind of talk about our products here for a second, with the variable loan rate capped at 6, what does that mean for your client? Well, obviously there's some companies out there that have most companies have a variable loan rate, but it may not be capped. So if they're doing an illustration and they're using current assumptions of, say, 4% or 4.25 or what have you, and 20, 25 years from now when the client goes to take a loan, if we were illustrating those, and now current rates are at 8%, you can see how that can make quite a difference in that illustration. And obviously illustrations are illustrations, but a lot of times clients will almost kind of look at those as bond. If they're showing a certain loan rate, income, if you will, off of that based on 4, it's going to be a lot less at, say, 8%. Whereas here at North American, even though we're currently charging 4% if you were to take out a loan, we illustrate our loan rate at 5.8%. And we do that because we've taken the last 30 years and back tested it, and that's what it would have averaged. So in that same scenario, if loan rates are at 8%, we're going to be charging 6. So based on our illustration, we're only charging you 20 bips more. Going to make a huge difference. So that's just a little spiel I wanted to give about our variable loan rate as compared to other carriers, because it does make a big difference on the back end when you start taking loans out, what that rate is at, obviously. So finally, we're going to discuss why are annuities and life insurance different as far as how we do the crediting. One of the questions we get occasionally is a question on why life insurance annuities have such different cap and participation rates on index life versus index annuities. Now, our annual cap is 13.5% right now on the S&P 500. In my former life, when I worked at an MGA, we did a lot of annuities, and I think when I left, it was around, if you got 4 to 5% on a S&P annual point-to-point cap, that was a pretty good cap. So, why is it so different? The answer is largely a two-part difference. The first one is the bond portfolio, and the second is the option budget. So life insurance obviously is a long-term vehicle which is priced based on long-duration bond returns. Life insurance companies use portfolio rates in their pricing, which is relatively stable and slow to move, either up or down. Annuities, on the other hand, are very transactional, and a small difference in bond rates can be a very big deal. Annuities are largely priced using new money rates, which is more dynamic and fast to move, either up or down. In the current environment, life insurance companies generally have a larger return to fund their option budgets than do the annuities. So, when we're talking about the difference in time, most annuities are 10 years or less, whereas a life insurance policy, generally, when we're illustrating, say, an income replacement scenario, we're looking 20, 25, 30 years down the road, usually. So you can see that there's a big difference in time there. The amount a company can allocate to their option budget is another important factor. Annuity companies can only make profit in one way, interest rate spread. So for example, if an annuity company is getting 4% on their assets and needs to hold back 2% for company costs and profits, then that leaves just 2% left to buy options, which effectively set the cap for par rates. Now, life insurance companies have many other design aspects available within policies where they can cover costs and generate profits. Thus, a life insurance company may be able to use a larger portion of the portfolio returns to buy index options. So instead of getting 4% and allocating 2% to the option budget, a life insurance company may earn 4%, but they can allocate, 3%. Now take the combination of these two factors. Instead of getting 4% with a new money shorter duration rate, life insurance companies may be pricing using a longer duration portfolio rate of, say, 6%. So now instead of 2% spread for profit or loss, or profit and cost, a life insurance company may need a smaller amount, such as just 1%. So instead of having the 2% left to buy options like an annuity, a life insurance company may have 5%. Now that's a big difference, and that's a reason why we see such large differences between life and annuity indexed options in this current interest rate environment that we are in. Now, that doesn't mean this is always going to be the case. Annuities, by their new money rate nature, are quick to move. If we get into a significantly rising interest rate environment, it's entirely possible that annuities could have higher cap or par rates than life products, which will be much slower to respond to a rising interest rate environment. The bottom line is that life and annuities are different in their pricing. They're priced with different assumptions and cost. There is justifiable reasons why we are currently so far apart because of the interest rates and the duration of time that most of these products are held. So today was a pretty quick one, a lot of information, but that is the presentation for today on how insurance companies, life insurance companies, price their index universal life products. And I know we spent a lot of time comparing them to the index annuities because that question does come up a lot with agents out there, especially agents new to life insurance. If they're selling annuities, how can you afford to have these high caps? How are you going to make any money? How can you give that money to my client and not just tear the caps down and lower them every year? And it's because of these reasons that I just gave today. Just one more thing I want to mention: we've had our index ULs for 7 years, and our annual cap it's currently at 13.5. It had a high of 14, and it had a low of 12. So over the 7-year period, that's the most we've moved it. So as you can, like I said, we've had a high of 14. That's when it first came out. It's currently at 13.5, low at 12. What's that mean to you? We moved it up when you know, economic environment got better, and we were able to do that. So with that, I would like to take any questions that you may have.
Currently don't have any questions at this time. There is a chat box there if you guys want to pose a couple of questions to Chris. We know it's obviously more technical, you know, side of the IUL process, and we feel that, you know, all of these obviously raise some valid questions as you're trying to present these types of products to your client. So we do appreciate getting you on. We just want to give you kind of what to look for next week. The goal here at PINNEY Insurance is to have a full operable landing page that has all the content so we can revisit it in the future, as well as some additional materials that are in conjunction with actually going out and presenting the IUL product. So look forward to that, and everybody that's been on the call both this week and last week or have registered will get some information early next week about that. So we do appreciate you coming out. Look forward to seeing you again next week. If you have any information that does come up, please email us at PINNEY Insurance. We want to wish you a great day today, and good luck out there. Thanks again for attending.
Thank you.